All right, I'm Matt Davio, back from the One Minute Trader with the One Minute Trader podcast. And this morning, I'm lucky enough, I'm very interested in volatility as a trader, and I've been following Stuart and his team, and they've got a product called Invest in Vol. You can find them investinvol.com. Stuart Barton is a PhD CFA managing partner of this firm, and he is a volatility specialist with more than 15 years experience managing volatility portfolios. He holds a PhD in economic history, which is fascinating. I was both a economics and a history undergrad, but I definitely didn't get into the depth that he did. So we'll talk about that a little bit. From the University of Cambridge, also very impressive. Not, again, I'm just a University of Michigan grad. MBA from the University of Surrey, an engineering degree from the University of Cape Town. Stuart is also a CFA charter holder, which in itself is not an easy task. He started his career with Anglo-American in South Africa after completing his engineering degree. So I'm assuming you weren't trading right away. After returning to the UK in 2000, he completed his MBA. He joined Barclays as a trader on their equity derivatives book. And in 2004, he headed to New York, where he established and grew Barclays equity derivative presence as their head U.S. index volatility trading. In 2007, he moved to Hong Kong. Man, you've had some great experience. What a resume. And in 2014, he returned to New York and founded Corpus Partners, an exempt CTA, commodity trading advisory firm managing volatility accounts for high net worth individuals. So this volatility thing, Stuart, and then in 2016, you joined RecShares as their CIO, Chief Investment Officer, where you helped develop the first VIX exchange traded funds under the Investment Companies Act of 1940. Whew! Wow. So Stuart, thanks for coming on. And let me ask you the very simple opening question for our viewers. How do you define volatility?
Yeah, I mean it's a good question, because I think to most investors, particularly US investors now, it's all going to be focused around the VIX. Now, of course, there's so much more to this, and volatility trading has been going on for since the 70s. But to me, underlying all these products, the VIX products and other similar products in the US, is this idea that you can run a dynamic portfolio where you might be able to buy and sell at different times. Now, this feeds into the sort of option hedging theory and the way people typically dealt to hedge options. So, underlying a lot of these investments are a sort of options valuation type of problem, where a lot of option valuation can be defined and can be hedged. What stock prices, what the interest rates are, etc. But there's always this little sort of unknown, and that is, what is the volatility going to be like? What are you actually going to realize in the term at which you hold your option? And it's that realized volatility that's really, I think, at the crux of what people want to get at. They talk about the VIX. Oh, the VIX went up, the VIX went down.
Yeah.
The problem with that is it's all about implied volatilities. It's all about a product that's sort of a derivative of implied volatilities. And it's always a tough question to answer, because the answer is different to sort of different people. If you start talking about option volatility to people, you lose half of them. They just want to talk about VIX.
And that's exactly why I asked you, because most people do assume, oh, he's just talking about VIX, and most people don't even understand what the VIX is, as you well know. And the VIX is so it's so focused on, obviously, the S&P 100, and so that doesn't really tell us much. So,
well, I mean, it's evolved over the years. Of course, now it's focused on options on the S&P 500, but as you point out, it started out in the old 100.
Right.
I mean, look, to me, it's about actual realized volatility that occurs in the markets, and that's all about uncertainty and people's beliefs and various news and such like. The rest of the products are some sort of derivative of that.
So, and then when you look at these different types of volatility, historical, implied, how do you use these, and how do you explain to people what it is that you're trying to capture and what you're doing? And we'll get into what you're doing specifically, but how do you use historical, implied? How do you calculate those volatilities? and what types of time frames? I guess give us kind of some reference for those issues, and then we can jump off into what you're working at, because I think it's fascinating.
Right, okay. Well, to start with, most volatility trading, particularly in the retail space or the non-commercial space, has become around the VIX type products. So obviously the CFE, the CBOE, has had tremendous success with the VIX futures, which have just grown and grown and grown. And I mean, you can see now there are just billions of dollars of the stuff traded a day, and this has been a boon for the exchanges and on their exchange fees. But these are fantastically popular products. So ultimately, a lot of what we do is catering to people who in some way want to be involved in that market. To be fair, not many investors we deal with are particularly interested in trading complex option strategies. They would be more interested in somehow being involved in the VIX market, which has just become a super popular world. So what we've primarily focused on is the term structure in the VIX futures.
Okay.
Now, the VIX is an interesting, we call it an underlying, but ultimately it's a calculated index. But the interesting thing about it that sort of differentiates it from other things, or most other things that futures are listed on, is that there's no arbitrageable opportunity between the VIX and the VIX futures.
Right.
Now, this differs. If you from things like oil or gold, you can buy the gold, borrow the money, sell the future, and the different sort of repo gap is things like cost of storage, insurance, these sorts of things. But these can always be hedged, and there's a physical arbitrage. The same with oil, most commodities. But the VIX is something quite different. It's one calculated number and then a tradable future. And, people have got different views on where that future should be, etc. And the reason, or the interesting outcome of that, is there's a true risk premium that appears. There's a true, as soon as there's a difference in the price with the VIX and its futures, there's that difference is not an arbitrageable difference. It's not a difference that you and I can put a spread on and say, right, we've locked in 6 basis points and we're just going to run it.
Right.
There's a premium, and that premium is to access it, you're going to have to take risk. And of course, then it comes down to whether or not you think that risk premium is valuable enough to take the risk that you're likely to have to take. So what we do is we deal in that space. We've got strategies that harvest that spread, that potential risk premium, and then we have ways of looking at the markets and deciding whether it's a good time or not a good time to be looking to harvest that. I think a lot of investors would have seen tremendous returns of products like XIV over the last few years. Mm-hmm. But at the same time, I think they're quite aware that the drawdowns of these products have quite enormous.
Right.
Particularly if you go back far enough and have a look how they perform in volatile markets, and you see periods where these things draw down 60+%.
Yeah. Well, here's the thing. I mean, you've been in this business, you've done this long enough, and you're probably, in many ways, you're in the sweet spot. You're in an area where there's so many people coming in and selling vol, because it works. And then, the elephant in the room, which is volatility, does exist, but that elephant has been really quiet for a long time. So the danger in these products right now is also, to your point, like everybody is on the short, selling vol side of the equation. Everybody meaning everybody's smarter than me and you right now combined, which is, that's the way the world is. It's just, we get into these moments where things happen. So with that, with the popularity of the products and like you said, these inverse and reverse ETFs and ETNs and all these products and so many fees, and they're such a boon for those that created these products. Why is now the right time, in your opinion, to invest in vol? And I love the name of your product. And give us a little idea. Now, you have obviously some strategies that you run, and then you're basically working as an introducing partner for a number of other traders who have volatility products, if I understand it correctly.
Partly. We run a portfolio of strategies. So I was describing this sort of volatility premium harvesting that is done. And it's done by a lot of people. It's done rather in a non-unrigorous way by some. Some people have been lucky.
Right.
Some people don't understand it and just find that buying some of these products has worked out. What we've done is sort of, we went through probably 10, 11 of the leading products that are out there, the leading strategies that are out there, and just dug through them and found the three that were least correlated, most diverse, looked at this problem in different ways. And then we put those strategies together into one strategy. So it's sort of a portfolio of strategies.
So when you're talking about correlation, just in case people don't understand it, in your terms, define what you mean by non-correlated.
Well, in this particular instance, we mean the daily returns of the strategies tending to move in different directions or at different rates. Mm-hmm. So I'll give you some examples of a couple of our strategies that are quite focused on the actual levels of volatility. So the actual levels of, for instance, VIX being one measure of implied volatility. Whereas we have another strategy that's much more focused on the steepness of the curve, so the futures curve. Now, what's quite interesting, you can have a very steep curve at higher volatilities, you can have a flat curve at low volatilities. Now, so these are two different sort of world views on volatility world and when's a good time to get in or out. And what's interesting is they will frequently signal a buy, it should be long volatility, short volatility, at quite different times. And what's quite interesting is all of these strategies have been quite profitable over the years. But by putting them together, by putting these three sort of fundamentally different, uncorrelated sorts of views together, the returns are much the same as you might expect from any volatility strategy or the better volatility strategy. But what's more important is the drawdowns and the actual volatility of the returns becomes much lower. And that's what we've tried to achieve with this sort of diverse approach to a portfolio of volatility strategies.
And how many people are you in your team that are working on these three components, these three legs?
So actually doing portfolio management is myself and my partner Justin Young. Mm-hmm. Then we have three volatility strategists who are three independent strategists who have been doing this for many years and have their own sort of approach and way to go about this. Right. And like I said, I chose these three guys with these three strategies from quite a large number of, I was in this lucky situation of this reasonably well known in the volatility market in the US and being able to get people to sort of submit their strategies for me to have a look through. So I think we're sort of in this unique situation where we were able to see most of the strategies that are presently being used. So
gotcha.
So I chose these three eventually, and we sort of tweaked them a little bit to make them a little bit more investable. I mean, it's really what we're trying to do. We're trying to find a way where the average investor could have a more sustainable set of returns from the volatility markets than would come about from just buying XIV and having to suffer a big drawdown every X number of years.
Yeah.
So that's why we've called it invest in vol. Rather, everybody seems to be trading volatility. I think it was. Right. Something like $7 billion of volatility ETN traded yesterday. It's unbelievable.
It is unbelievable.
It's they're always coming up in the top ETN ETFs that are trading. People are in and out today, which is great. But what we frequently find is people will do this and they'll have a good run for a few weeks, or a few months, or even longer. It's when it goes a little bit wrong that they suddenly realize, or they start to ask us, and we're a registered investment advisor, so we give advice other than just run strategies. We also help people with their own understanding what they do.
Yeah.
And the questions are always, you left with a feeling of, well, I would have thought you would have known that before you put X portfolio in, and often they're surprised that, oh damn, I didn't pick up on that or didn't know. Because these are complex products. It looks like a number that trades on a screen, but the derivatives are derivatives are derivatives, and that should be remembered.
Well, this is the thing, and so talk about that a little bit more, because I think, like you said, people view these products as just another ETF, and they're really, sometimes fourth, fifth, sixth level derivatives on products that they don't even understand the first level,
Yeah.
In other words, if Apple has a 23% implied volatility, what does that mean? That's simple, but we're talking about the volatility of the implied volatility and the historical volatility of Apple. And,
Precisely. I'll give you a quick sort of a summary of what's out there. So obviously, I think people normally start with this idea of the VIX, and people talk about it. Now, obviously, as we said already, the VIX is a calculated index from a bunch of option prices. Those are options on the S&P 500, portfolio of options. Unfortunately, it's not a static portfolio. It's a portfolio that moves every day, every minute as the market moves. So that's one calculation that's sort of taken. So that, in a way, you could describe, the options clearly a derivative because there's an option on the S&P 500. So there's
Right.
a first level.
Right.
The VIX index, then you could say, well, that's an index which is a calculation from derivatives. There's a derivative. We then, the CFE have launched their futures on the VIX, which of course now are a derivative, and those are obviously very liquid. Then we get into the ETP world, and within that group, these are varying approaches, but they're either ETNs, exchange traded notes, or exchange traded funds. The exchange traded notes are debt instruments originated by large banks that have an equity link, that they pay out an equity based on a formula, but that formula is calculated from the futures, which is calculated from et cetera, et cetera.
Right.
So we're getting into the fourth level there. And then ETFs are actually funds. They actually then buy the futures, the VIX futures, and they hold the VIX futures. So there's a difference there. But you could certainly say there's four levels of derivatization in that.
Right. And so with that alone, and the girth and the size of the market, when there is volatility and when there is not, there are two completely different beasts. And because of the nature of those derivatives themselves and the levels of those, you've got basically a real danger situation for those that are uninitiated to true volatility. And true volatility is, obviously wherever we are is wherever we are, but we all know that if you just go back again, to me, it's like climatologists. They go back 100 years. How about going back 2 million, 20 million? Because those are the real numbers. And if you want to go back 20 million years, again, I'll just use this analogy. We're really at the top of a normalization curve. And we're probably, in my opinion, and I'm no climatologist, and these guys didn't exist 20 years ago. But my point is, we're probably, and you and I will be dead before this happens, but we'll probably be in a, forget about, climate change to the warm side. We're going to actually go into a freeze like we do in that cycle. And so I say this only because I think the unknown, or people don't look beyond the last 5 years when we've had zero volatility and we've had so much intervention and so many things that are we can't compare them to any time and really markets and modern markets, I would say 400 years. These products, there is nothing to base them against in the past.
You're quite right, and I think to the point of the volatility products, there's something that's quite important has happened. People do a lot of back testing on how these volatility products have performed in the past, but the problem is they're all relatively new. Most of the ETNs, ETFs came out in 2009, 2010, so we've got only a limited history.
Right.
Even more importantly, the underlyings on which these products are based are becoming a smaller part of the entire market. Perhaps I should put it the other way around.
Yep.
The ETN or the ETF derivatives, the products that have been created, are becoming a larger and larger part of the overall market. So if you look at some of the larger ETNs and ETFs that are sitting at $1 billion plus. This is $1 billion plus of Vega position, volatility position that's been held in very short-dated volatility products. Now, back in the days when option volatility trading in the S&P was a bigger part of the overall volatility market. Short-dated options they carry very little vega. They carry very little volatility exposure, implied volatility exposure, but they do carry a great deal of gamma, a lot of sort of intraday, daily movements risk. So if you put these things together, the important point is that these short-dated ETN and ETF type products, now that they're as large as they are overwhelmingly larger than the short-dated S&P volatility options market.
Right.
So we've got to a point where it's a tail wagging the dog, but overwhelmingly.
Okay, so let's touch on and let's dive in a little bit deeper and tell me, what does this mean to you as somebody who is a risk manager first, right? So what does this mean to you as somebody who's trying to profit from this knowledge? Because most people don't look at it the way you're looking at it, and it's very powerful. What you're going to have to say about this.
Yeah, I think that there's now a tendency to or perhaps there's an important move to understand the exchange traded products as trading a bit more in a technical fashion than we previously thought. Now, I was at Barclays when we were discussing the first of these products, the VXX, which was the genesis of this whole thing. And at the time, we assumed these things would be managed, would be used by managers, mutual fund holders. It would be something that would be for the professional market, people that needed a hedge, large.
Right. You guys created a product that you thought that pros would use to hedge. I mean, it's simple as that.
That's sort of you've said it there. And you know, and what's changed?
And where has that? What is it now then? So that's interesting because you were there. You were there from here's a concept we can go out and sell. Here's what we think they'll love buying this because it will be able to hedge. It's a hedge.
Well, exactly. I think, the VX. Why did we decide eventually to go for a long product, long before the idea of a short product, and it was because it's an obvious hedging product.
Yeah.
It's as a manager that can't necessarily sell something, but it wants to take a hedge for a short period. That product could be fantastic. You hold it, and if things do move on you, you get a pickup on that. But I mean, I think what we notice now is that the big interest, as you said, is in the short volatility side. So I think there's big interest in short VXX, there's big interest in long XIB and SVXC, etc. And then added to that, the daily volumes of these products. So typically you'll see about 80% of the assets under management trading daily, intraday. There's nothing. Imagine if 80% of the float of the stock was traded every day. This is a very very liquid.
Those are the types of stocks I loved to trade in '98 through 2002.
Yeah.
And we don't have the reason why people like me are in them because there is that huge turnover of float happening every day.
Yes, right, exactly. Yeah. And I think what this tells us is that there's been a shift away from institutional users of these products towards retail users of these products, and
right.
And that's what underlies our business idea. That, there's ultimately we've got a less sophisticated, sometimes more sophisticated, but there's a great number of less sophisticated users of these products, and it's important that those people understand what they're getting involved in. So ultimately that's our niche in the volatility space. But getting back to your point, how's it changed? Well, the investor psychology, a retail investor who's holding product for several hours, who's a day trader, people act differently to an institution who was using it as a hedge.
Yep.
Who had to have a 3-hour meeting before they were allowed to put their position on, and need to have another 3-hour meeting before they take it off. This is a different environment. And we can see that. So if we looked at the last couple of days, we saw, the S&P was, down like 80 bips percent. It was, we saw a little bit of a pullback. But what we saw in the volatility products, the ETPs, and therefore the futures that ultimately they're involved in, these things sort of massively exaggerate the move. Suddenly It's like, oh well, the world's coming to an end. Some of these. I think the VIX.
Yeah, I think the VIX didn't it? I mean, it was front month was probably around 12.10, 12.15, and it spiked up.
Exactly. No, and the VIX itself got to about 13.
13.
I think Friday it closed below 10.
Yeah.
So that's a big move for talking about a percent or so move in the
not even a percent as on a closing basis. I mean, we basically came back to even. I mean, come on.
So what we monitor is in the S&P options pricing. There's, I'm sure many people know all about it. The sort of skew that is priced into the option. So the volatility for every different strike implied volatility is different. Lower strike options are traded typically on higher volatility for various reasons. But and what is notable is when we have these moves, how quickly these products outperform the skew.
Yep.
And that's probably down to this sort of technical nature that the more retail investor is following, where it's it's starting to move, and therefore we will get involved in self-perpetuation. It moves even more, but it does mean that we may bring about some interesting volatility in the volatility products that might not be triggered, or may be triggered but might not be justifiable by the underlying S&P market. So, people talk about when's the big event coming, when one of these ETPs sort of goes to zero, and there's a lot of chatter in the blogosphere about this stuff.
Yeah.
And then people always go back, the Dow would have to, the S&P would have to. And the problem is that's not necessarily the case anymore.
Right.
We might get a day when the S&P is down 2%, and that is enough to trigger a sort of technical move in the volatility products that is not sort of fundamental in any way. It's not that, the options should have moved so much because of the skew, therefore the VIX future should have popped by so much, and therefore the ETP should have fallen or risen by so much.
In other words, the math that fundamentally was created around and about these products is to use a play on your skew, is skewed beyond the reality of how it was set up. In other words, you've created a monster. You meaning the industry, right, has created this.
I guess some would say that the feedback now goes the other way. So I think if you're an options market maker in the S&P, of course one of the things you're going to be watching extremely closely is where the VIX futures are trading, because so much of the volume is coming in through the VIX futures, which in turn is coming in through the ETPs. That this is driving. Because there's some not perhaps an arbitrage, but there's somewhat of a risk play that obviously people are trading between the options and futures. But years ago when these products first launched, it was very much a one-way information traffic flow. That it was the S&P options drove what was going on in all the products that were derived from it. And now we're in this position where. And I don't know there's probably all sorts of interesting risks that we could talk about that are associated with something like that. But perhaps a big picture comment would be that these products have effectively become something of their own product. It's almost like it's relatively irrelevant. If these things became 100 times larger than their underlying market, it would be somewhat irrelevant what the underlying is.
But the thing that comes into play is when the products do have to behave based upon what they were created to behave upon. As you said, they could be two things. They could be muted. They could be, which they maybe in many ways have been today, and then they could also be exaggerated when the technical component again of the market is such that everybody runs through the fire exit at the same time, and so, these types of risk, gosh, I don't even know how to term the name for this type of risk. It's really unknown. And how do you put value then as a trader, right? Because my job as a trader, and let's get into this a little bit. Would you consider the way you trade technical, fundamental, or behavioral?
I'm going to say fundamental, and it may surprise you after what I've just said about the technicals. But in essence, what we are doing is we are looking to remove a risk premium that appears in that volatility market. Now, everything I've just said to you would indicate that I believe that we should have volatility in the market, and in fact, possibly that we could have spikes in volatility. There should perhaps be more. but really, what's important there is the understanding by people that there can be spikes and that there probably will be spikes, and that we've had spikes this week already. That the importance of that is that it creates this world where there is a risk premium that exists. If you and I and the entire world agreed that there was no more possibility of volatility spikes in the future, there'd be the VIX futures market would trade very flat, and there'd be very little premium.
It'd be like the milk and the butter markets, right?
Right, there we go. Yeah. So the interesting thing for me then is that does exist. I think that it always exists. I think there's always fear of the unknown, and like insurance companies, that if there's no more hurricanes, it's people don't buy insurance anymore, kind of thing.
Right.
So that's why I say it's fundamental. We look at when is the best risk-adjusted time to try and take some of that premium out of the market.
Okay.
And instead of the big ETP type of products where a buy and hold strategy in them would be nothing more than sort of equally weighting your probability of being able to harvest some premium, because you would just hold it every day, so you would take the good with the bad. What we're doing is we're looking for opportunities when our analysis would show that there's a fundamentally better harvest on offer for a given similar amount of risk. And of course we're not going to always get it right, but by just being systematic and carefully choosing a time when, well, if there's little premium to be taken out of the market, there's little risk premium available, but the market there's interesting things going on in the market, and possibly things can move around, that's probably not a good time to try and harvest a risk premium. Whereas times when it's always, I always think it's very exciting when you get a lot of news about something that's always very unlikely to happen, because the risk premiums all pop up,
right.
And then it starts to relax. It's a wonderful time to be sort of say, well, I'll take some of that risk premium as some people are.
So do you look? I mean, are those things that you and your team are looking for are usual but unusual? Chatter. In other words, we like to harp on the fact that the Rocket Man is throwing rockets out there, and and you laugh because that's the way I look at it too. I love when that stuff happens, because the fear is it's to me it's generally not worth the premiums that are being put.
Exactly. Yeah. I mean, look, so we don't do anything that I describe as sort of news following or news reading. All our strategies are entirely formulaic, and what they do is they take they're taking feeds from market data. So for whatever's going on in the world, I'm a sort of efficient market hypothesis kind of guy. I believe starts to appear in the market, so that's fine. So some of our guys will look at sort of varying indexes, moving averages of indexes, which are all kind of technical ways at getting at kind of signals, which then together with how much risk premium is available, kind of bring you back to a point of saying what probability do we assign to be able to actually extract that risk premium. What's the risk involved? How much is it likely to make? And you try and pick the best times. So our strategies vary from being times 100% in cash right up to being 100% invested in a short or long volatility, and everything in between. So we'll find that our strategy is daily or even intraday changing.
Gotcha. And how with a market again that has been moving one way really since election night and doesn't sell off, does at all?
Yeah.
How do you view? How do you put yourself in a position that you don't get lulled to sleep? You said you obviously have some quantitative models running in the background that are alerting you, I would suspect, to things that fit into your parameters and your zones. But you've also said some things technical and fundamental and behavioral, and you studied behavioral economics. Historical economics to me is behavioral, right? People do the same stuff over and over again. They make the same mistakes. Doesn't matter. Hopefully, we learn from them. So, behaviorally, do you believe there's an edge that you bring to the table, having not only traded these products but created these products? Really understand the underlings. And then when you look at who is behaving in the markets, and you touched on this earlier, and I'm sorry for the long question, but I'm trying to get at the meat here, which is there are different types of traders. We all know this. Some are price sensitive, some are not. Some are time sensitive, some are not. Some have billions and billions versus millions. And how do you discern in these volatility markets those players, because it does probably affect pricing? And then therefore, do you use tools that can show you kind of who is in the market and kind of where the strong hands and where the weak hands are these some of the things that you try to utilize?
They are. Things we look at which are important are the intraday volumes of the products. Now, clearly there's been a move towards shorter term holding of the ETPs.
Mm-hmm.
What's interesting is how people react during what perhaps people who've been trading for more than 5 years would consider absolute minute movements in the market, and how people react in the ETPs, how quickly they react. All of this, the trend we've seen has been towards this shorter termism, this day trading kind of mentality. And to me, the way I interpret this is we've got a crowd of people or there's a dominant, or the dominating force on these products are people with quite a short-term time horizon, and that's good for what we do. We can take advantage of that, or at least we can react to that in a different way. We have our investors are hopefully understand what we try to do, and we're not trying to make them rich in an afternoon. So we can react a little bit differently, and I think your point is a good one, that as there's been an evolution in this volatility market, there's needed to be an evolution in the way to make money out of them. And something we haven't spoken about, but is also very important, was the dominance, even up until 5 years ago, of the major investment banks in the volatility space. So I for many years traded for large banks, where of course were able to run enormous positions, which meant if volatility went in one direction or another, you could take a view and probably profit from it, or you'd see a lot of customer flow, etc. But that's disappearing. Those desks that would have multi-billion-dollar books are shrinking, and some of them have disappeared.
Why? So, can I ask you why that is?
Well, a lot of it is simply the regulations that obviously have come in. I think the Volcker rule that made it quite difficult for banks to take on certain positions. I think also the pressure from shareholders. What is it exactly that this bank should be doing? Right?
Yeah. Okay.
It should have large positions.
So you're not necessarily saying volatility per se as a product has shrunk, but all trading really on the investment.
Well, I think that the move has been away from the institutional traders that have got a certain style and a certain. They're chasing a certain type of premium to a retail investor who seems to have a much shorter time horizon and is more reactive.
Right.
And I think that explains what's happened this last couple of days.
Sure.
The way that the ETPs reacted so quickly to such a small move.
Right.
I think if people have said, well, I've already made 10% out of this product this month. It's starting to move down. I better sell it. And then everyone
right.
So you get these overreactions.
Yeah, and so with these overreactions, what happens when you have an actual 2 weeks of selling?
Well, I think that's right. So there's two things that are clearly occur. At the moment, when we get a sell-off in the underlying indexes, the S&P, for instance, we will see a spike in the ETPs that seems to exaggerate the long ETPs. It seems to exaggerate the what's actually happened. So this is this short-termist investor psychology. I think people say, well, there's no point holding on, I have to get out, and, self-perpetuate. And then people are talking at the moment about what are the beta of these products to the S&P.
Right.
And so the way that a lot of the chatter on at the moment is about is, the beta of these things spikes. That you start to see the ETP betas go up to sort of 8, 9, 10, 11, 12, and then they really pick up. Whereas historically they'll average 4 or 5.
Right.
So that initially happens. Then you'll find the index sort of carries on going sideways, and then what happens is these products typically recover a little bit.
Yep.
But then, even if they do continue to fall or move, they then tend to move at a lower and lower beta. And I think that's you starting to get through the sort of day trader band, and you start to get to people who have got more sort of 1 week, 1 month, 10 years, whatever, different sort of.
Yeah. So again, the multi-time strategists, I mean, this is the way I look at markets. Like I do look at kind of 9 time frames. I'll look at, okay, here's the day trader, here's the 1 week trader, here's the month trader, here's the 2 week, all the way out to a 20-year longer term plus. Yeah. And I think you're seeing this in so many products, which is fascinating, right? It's ironic because I think you're seeing more and more short-term trading going on, and yet volume overall, like long-term, like generationally, is at a low. Like I think we're at like overall 30-year lows when it comes to like the markets, the participation. So participation is low, and it's very concentrated into. I contend these ETF products, including volatility, being amongst those, right?
Right. Yeah. I mean, the ETF's a little bit different in that. The volatility world's a little bit different in that the ETFs, in many ways, have given access to the retail market, something they didn't have access to before. Whereas the ETFs that are, index or thematic or something, equity based. In many ways, then I agree with your argument that what's happened there is you've centralized the people buy the ETF and then they don't need to go and buy a bunch of stocks. So it changed the dynamics of the market. And I mean, there's a good argument for why that is. That evolution has lowered volatility in the equity markets in itself, and that you've got a more index-based, more
So, but let me ask you. So, I do stay up night thinking about these what if scenarios, and maybe I'm way off base, but what if we've got so many short-term ETF, and I'm just lumping volatility into the ETF space, right? I'm not saying volatility is the only thing in there. There's so many of these passive products. What if people wake up and they all they're all like they don't have baskets anymore. They, like you said, they're buying these ETFs, and the individual stocks, the volume on the individual stocks themselves is already at a low, and all these people press sell at the same time because Rocket Man does do something for real. What does that do like to the complex and to the market itself when those things happen, when they all have been kind of short-term in nature and they all think they can get out before the stampede, right?
Yeah. So I mean, an ETF, has a sort of trades in two separate worlds, in two separate markets that I think perhaps people forget about, and that is, in today you've got market makers who are often not affiliated at all with the ETF industry. They're looking at taking arbitrage opportunities, and the ETF is cheap or expensive compared with whatever it holds. And then and that's your daily. That's the daily market, and that has one effect. You've then got the sort of the wholesale market that goes on around the close, where you have the creation and redemption process, and that's where you actually have to go along to the ETF firm where they create a new ETF for you, and they give you the ETF, and you give them all the stocks that you bought during the day, or you give them from cash, or however you decided to do it. But I mean, your point is a good one. That what happens when you start to get to a point where the ETF becomes more liquid the things that underlie it. I've been involved in the creation of products where that's been the case, and it becomes quite tricky. You can get to you can get to a point where there's a possibility that the ETF trades at a price that's different to the sort of theoretical price that the basket might indicate. It's an interesting situation, but I don't think it isn't in itself a dangerous position or something to worry about. And then what happens is you start to get another type of sort of risk arbitrage, risk trading that's going on, where people say, well, I'll tell you what, I'll sell this guy this ETF. I know I can't buy X number of stocks that are available today, but I reckon I can pick those up over the next 5 days at this sort of price. And so I think the market finds a price for that risk, and people step in to take that risk premium off. We found it with there's an active market between the ETPs and the VIX ETPs and the VIX futures. People make sure that thing stays very close to its theoretical price. And it can't drift too far away. But there are times the bid offer spread on the futures can pop out, and it's no longer a pure arbitrage. But at the end of the day, people are stepping in to make that trade because they believe, using whatever model they have, that these things come back to.
They have value. Yeah.
Yeah, and they have value. Yeah.
So let's break down who can invest in your operation. What types of people should be looking at invest in vol type your products.
So we launched the strategy, and our main strategy we call the balanced volatility strategy, which is a strategy of three fundamentally different volatility strategies in one account. We launched originally with the idea of the retail investor in mind, the kind of guy that would be asking me, oh, how does this XIV thing work? And you try and answer, or how does VXX work? And you try and answer it, and then realize, well, he's already got X percentage of his investable assets in this thing, but he doesn't understand what it is. So, and I think that's a dangerous situation. So we thought, well, there's an opportunity that retail want to be involved in volatility trading, but perhaps need to do it in a way that sort of makes it more investable, means a bit more helpful to them, a bit more educational and helpful. So we've tried to create what we believe to be a more investable solution than that. And our products to individuals are the kind of things we recommend people hold for 5 to 10 years. We don't recommend anybody invest more than 10% of their investable wealth in it. We see it as a sort of a product that just is a bit of a sweetener to one's portfolio. People often call it volatility investing, and indeed, that's what we call the firm. But ultimately, we're pulling a risk premium out of the market that is not accessible elsewhere. So when people have got a diversified portfolio in there, they might have some alternative assets. We see this as being something that.
Well, you're giving them a way to invest in these multi-layered derivative products that it takes a team of people to really wrap their arm around.
And then we offer the sort of education and the service that they need in order to be able to keep it as an investment. They don't want a terrible surprise or with no one to ask. So that was the original idea. But since launch we've actually had an overwhelming amounts of interest investments has come from other advisors. So across the US, we've got advisors that have been encouraged by their clients probably to put them into some volatility products.
Yep.
Which they've done, and they've read what they could on the internet and etc. But ultimately, these advisors are fiduciaries to their clients, and I think a great number of them are quite worried when they start to read stories, technical stories, perhaps about these products, and soon realize that they don't understand them. So we've sort of found that we're quite well positioned in that space. That we've sort of become a sub-advisor to these advisors that come and say, well, I've got these clients, they've got X number of $100 million with me, but we've got the small little slice in volatility. We would prefer it if you took that from us, and that's worked out very well for us. I think the the advisors we worked with have been very happy. Somebody was saying to us the other day, says if it's just the ulcer that this volatility stuff was giving him that he could just do without. So
well,
okay.
I mean, it's a great way. Again, you're getting, one of my former business partners, trader, he worked at O'Connor. I mean, these guys invented this stuff, right? So, I mean, they were the first true quants who basically created they created VIX. And so, they traded it. And I can tell you, when I talked to Jeff today, he's like, I have no idea what's going, like, and they created them, and Jeff's like you, he's a math guy. He understands. He's just like, I don't even know, where to begin and dive down the rabbit hole and getting my arm around all these products. It's a lot. I mean,
exactly. And I mean, we're finding even then at the, we've even found interest now from hedge funds.
Yeah, I believe it.
And there are hedge funds that they get, because we always think hedge funds are full of really smart people, and they do what they do, but often they're full of specialists. So that they they've got X, Y, and Z, and they're really good at that. That's where they're making money. But they also need to diversify. And I think people have seen that, look, there has been money to be made in volatility products.
And they also have a fiduciary duty, right?
Right, so, exactly. Yeah. So they've got to be careful on making sure that they've got that they understand what they're doing. So I mean, we offer our product to individuals, advisors, and institutions.
Mm-hmm.
I mean, we only specialize in we just do volatility. This is where we somewhat differ from a lot of advisors. There's advisors. The typical model is to be you do tax advice, you do estate planning, and okay, that's fine, but this is a big enough market to be a specialist in. Just
absolutely, and so I was going to say, Stuart, you really become kind of the doctor of volatility, meaning you're working with the orthopod, you're working with the urologist, the gastro guys, and you can help them to be less volatile in a sense. By putting what you're doing alongside what they're doing, which has huge value, I would think, to the to these specialists. You're a subspecialist, and you're helping the specialists across so many areas that I think this is pretty. You've picked a great business, I think, opportunity.
Oh, thank you. Yeah. It's good for you. Good for you to say.
So let me a couple more questions, and I've held you longer than I had hoped. You probably didn't want to be on this long either, so I appreciate you coming on. And where can people find you? Investinvol.com is your website. How about Twitter? Are you guys socially active? Are you on the?
Yeah, we're on Twitter. It's Investinvol.
Investinvol on Twitter, right?
We're on LinkedIn as well.
Okay.
So Investinvol.
And
then if people want to email me, I'm sbarton@investinvol.com. But there's plenty of places on our website where you can get in touch with us. That's probably
all right.
That's probably it.
Perfect. Well, I'm Matt Davio. Stuart, thanks again. Well, I'm going to have you on when we get some volatility, just so we can talk about what to do in these volatile situations. But I'm being lulled to sleep, so I appreciate you coming on and talking about what I do find an exciting topic, which is volatility and how diverse and disparate it is right now. So it's something that people need to understand more, and I highly recommend people check you guys out. Invest in Vol, follow them. They're smart people. They're way smarter than me. So keep listening. Appreciate your time.
Thanks, Matt.
Okay,
Cheers.
Take care.